Hey everybody, welcome back to Whiteboard Finance. My name is Marko and I'm here to help you master your money and build your wealth. In today's video, I wanted to touch on a growing issue that may or may not sound worse than it really is. We'll break that all down in this video and make sure you stay till the end so you get my thoughts on it. So American consumer debt just reached $17.06 trillion. And for those of us that can't comprehend how big of a number this is because of our lizard brains, that is 17,000 billions. Okay, so pretty crazy there. So let's get right into it. So personal consumption expenditures, you can see that they've reached 18.72 trillion. It's clear that consumer behavior has not slowed down. In fact, where you see my cursor in the red arrow here, it's actually gone up. So according to the U.S. Bureau of Economic Analysis, spending as measured by personal consumption expenditures continues to reach all-time highs. And I've kind of backed up this chart all the way to 2000, so you can see kind of like the dot-com bubble, 07, 08, COVID, all that good stuff. It's absolutely exploded. So if you look at the index of consumer sentiment, according to the University of Michigan, Americans are not incredibly optimistic about the current economy. However, on a positive note, if you take a look at the index of consumer sentiment over here, the dotted line is monthly data, the blue line is 3-month moving average. You can see that it actually ticked up over the past year or so. However, it declined month over month from August to September. So if you take a look at this consumer sentiment by year, I started it back in 2001 and went all the way to 2023. You can see that basically after the dot-com bubble, we were essentially in the high 80s to mid 90s. Then 07, 08 happened, so we're in the low to mid 60s. And then you can see it didn't improve until about 2013 and on. Then you can see in 2022, the index of consumer sentiment hit 59. Now we're currently sitting at roughly 65.6. So if we move forward, the monthly consumer confidence survey, that's where this chart is taken from, it basically delivers real-time consumer insights and market research throughout a panel of 36 million consumers. So this is pretty current and it's pretty accurate. So 16.3% of consumers expect their incomes to increase, down from 18.7% in August, as well as 14.4% expected their incomes will decrease, up from 11.9% last month. So if you take a look at this chart, this is basically your family's current financial situation based on percentage of survey. And you can see the blue is good, which is trending down. Bad is black, which is trending up. And I'd be interested to see if these lines ever converge in a few months or so. So you can obviously see that, that sentiment is starting to kind of deteriorate a little bit because things are getting more expensive. People are shaky about their jobs, and we'll touch on that in the My Thoughts portion of this video. So let's take a look at this next slide. So this country obviously runs on debt. This is the total debt balance and its composition. Americans rely on debt, corporations rely on debt, and we can see that here in this chart. This is mostly consumer credit. The source is the New York Fed, so it's pretty accurate, I would hope. But you can see here that 70% comes from mortgages, which makes sense. It's probably one of your biggest debt obligations out there. However, the other 24, and when I say other, I'm meaning for most staples in a home. So this is student loans, auto loans, credit card debt. It makes up 24% of that outstanding debt balance and its composition. And you can see, as I mentioned in the very first slide, we're sitting at 17.06 trillion. Student loans are actually bigger than credit card debt, which we're going to talk about here. So if we take a look at the non-housing debt balance, credit card balances increased by $45 billion. This is a 4.6 quarterly increase, and now we stand at 1.03 trillion, which are at all-time highs. That's right, credit card debt is at all-time highs nominally. So auto loan balances increased by 20 billion, continuing the upward trajectory that hasn't been in place since 2011. Other balances, which include retail cards and other consumer loans, they increased by 15 billion. So student loan balances declined by 35 billion actually. That could be part of maybe the loan forgiveness, but basically student loan balances now stand at 1.57 trillion, which we can see in this box right here. So in total, non-housing balances actually grew by $45 billion. So if we move on, this is where the presentation kind of gets a little bit more positive, at least in my opinion. You can see here that the good news is that delinquency rates were roughly flat in the second quarter of 2023, and they remained low after declining sharply through the beginning of the pandemic. So as of June, 2.7% of outstanding debt was in some stage of delinquency, 2 percentage points lower than the last quarter of 2019, just before, obviously, COVID-19 hit the United States. So if we take a look at this chart, you can see that this pink line is basically student loans. See how sharply it drops almost to zero? That's because of, that forgiveness or that pausing period or that grace period. You can see credit cards are blue, which are actually going somewhat down. They started to tick up over here in 2016, delinquencies, and now they're down, which is good. Mortgages are this orange number, which are all the way down. So there's barely any delinquencies since basically 2009, 2010. And then also auto loans, they're kind of on the rise, but they're going back down as well, which you can see where my cursor is right there. So the home equity lines of credit, a lot of people were using these to invest back in like 07, 08. You can see how delinquent they became from 08 to 2012, and they've been trending down ever since. So over the last few years, U.S. GDP has actually grown. We did have 2 consecutive quarters where it was down, which is considered a recession. And then if you guys remember, the White House basically changed the definition of a recession, which was kind of funny. But a lot of money has been created. Okay, so if you remember on this channel, I talk a lot about M2 money supply. This is basically all the currency in circulation in a very simplistic way. But basically, all this money printing and all this inflation, this destroys your long-term purchasing power, you guys. You have to realize if you work your entire adult life only to have non-consensually have your government debase your currency right when you retire, making your currency purchase a lot less, aka reduction in purchasing power, that happens in the long term. But this also means that debt is devalued as well. So remember, $1 today is worth more than $1 10 years from now. It's called the time value of money. So when we look at consumer debt as a share of M2, it's actually down from pre-pandemic levels, although it is starting to tick up again right around here. So look at the blue line. This is debt to GDP. It's actually been downtrending somewhat. And then if you look at debt to M2 money supply, it's actually downtrending as well. So that's why this doesn't sound as bad as it does. Very quickly, if you haven't signed up for Whiteboard Finance University, frankly, you are simply missing out on the best finance community in the world. That's the only way I can say it. All of our members have unbelievable feedback. I don't want to pitch it too much, but it's something that we're incredibly proud of. So if you're basically looking to increase your income, manage your money, invest in stocks and real estate, we have professors and subject matter experts in all those fields. Check out the code consumer20 for 20% off. It funds this entire channel. So let's take a look at my thoughts here. So it's not as bad as it sounds, but as we saw in the first few slides, sentiment is starting to decline. So if consumer spending starts to decline, I believe so will GDP, right? Your gross domestic product. People are just able to afford less, buy less, do less, all that stuff. So things are stable because of the labor market. I mentioned this in my last couple of videos with the housing market video and then also the recession video from Deutsche Bank. Hiring is still strong, but that could obviously change quickly. So unemployment numbers, they'll obviously start to increase over time. They pretty much have to. We're almost at record lows currently still, which will obviously impact spending as well. So everything is okay at the moment. Again, this is not a doom and gloom channel. The only advice that I would give, or this isn't financial advice, is continue to dollar cost average into income producing assets. No matter what the price of stocks are, the S&P 500 is, Bitcoin, anything, you name it. I have my high conviction bets. I bought Bitcoin at $4,000. I bought Bitcoin at $65,000. It doesn't matter because I know what it is. Same thing with the S&P 500. Same thing with VTI. Same thing with the stock market. I continue to dollar cost average every week. Also, if you want to play some defense, I've been preaching on this channel, always have an emergency fund. If you're single, 3 months should be fine. If you have a family, 6 months should be okay. If you're a business owner, small business owner, your income is not 100% stable, or you're in a commission sales role, for example, I would actually do 12 months of cash, which does sound like overkill, but you will thank me if we do go through a downturn. So as always, I hope you got value out of my videos. Please share the video. Please send it to a friend. Send it to your WhatsApp group. Send it to your chat groups that you may be involved in. I try and produce high quality content and just not regurgitate CNBC articles. Hopefully you get value out of these. Thank you so much and have a prosperous day. Hey, Mom, I have $1 trillion worth of credit card debt.
Oh, that's okay. Just don't do drugs.
Oh, okay.